We'll call this meeting to order, just a touch late for a Monday morning. We do have, Greg will be excused from the meeting unless we take the meeting to him. That wouldn't be a bad idea, actually. Yes, yeah, right. Dan, you could probably negotiate that for us. I kind of like it. Okay, we'll call a meeting to order. Just with reference to the agenda, we're going to add one item on the end prior to adjournment, which will be an in-camera session for an intergovernmental update. Is there anything else to add to the agenda? Kelly.
If I may just take you back, I would make a motion to excuse Greg from this meeting.
Oh, thank you. All in favor of that excuse? Thank you. That's carried. Thanks, Kelly. Is there any other adjustments to the agenda? Seeing none, a motion to approve the agenda would be in order. Lynette, please, all in favor of approving the agenda? And with that, Matt, I'll maybe just ask you to just review a few of the standard procedures for this meeting that are maybe unique to the budget review.
Good morning. Of all the places you could be on a Monday morning, I think we can all count ourselves lucky to be in the County of Newell. Council chambers debating budget. This is the big show. This is where it all happens. I mean, it's great to have ideas, great to have vision, things you want done. It costs money to do those things, and there's always more priorities or things that we'd like to accomplish than funds that you've got available. So this is always an interesting conversation for staff. In terms of how the day is going to roll out here, sorry, but I'm going to get on my soapbox first thing. Just kind of give a high-level summary of where we're at with budget. We are lucky enough to have our friends from CIBC, Charrett and James. They should be coming in around 9:30 virtually to give us an economic update. So big picture, view of the world, things to be aware of. Over time, we've come to treat the budget review meeting more and more formally. So we treat this like a committee of the whole meeting. So we're not going to make motions to include or exclude things from the budget, but staff will take feedback from council today. And if there's anything that we need to make a decision on, we'll make a decision on that either at our next regular council meeting or at our December 8th council meeting, where we anticipate having the interim budget on the agenda for approval. So I think there's a few things that are interesting in the budget that should garner some good conversation. And with that, I'm going to jump up on my soapbox. Stephanie's going to run my PowerPoint here. You should be able to find it in an updated agenda package, which we circulated just a few minutes ago this morning. So with that, let me dive in. The County of Newell provides services, and I think it's an incredible business to be in because we have an incredible amount of variety, from dealing with land use, to flushing toilets, to keeping roads passable, supporting libraries, supporting our partners' recreation facilities, supporting our own recreation facilities, support to Halo, to STARS. The county is a big player in the region. There's a lot of good things that are accomplished with the taxes that the county raises. So some of the services that we want to focus on, we're coming out of budget planning. We talked about reinstating the coyote control incentive program. That's in this budget. We talked about a communications coordinator. That's in this draft budget. When Todd was presenting his policies a few weeks back, we gave him some homework. Hey, come back with some shelter belt programming options. That's not in the budget, but there is a budget planning form, and Todd will be in here to speak to that. And I think the first year cost on that for some additional staff would be about $40,000. So those we'd consider service level enhancements. Other items that are new, Terry's going to be in here asking you for a tractor mount gravel retrievers, recover gravel off the sides of the roads. Stuart's going to ask you for some rescue rams to help rescue people who might be pinned underneath their dashboard in a motor vehicle collision. And with our partners at the City of Brooks, there's a jet fuel system being proposed for the Brooks Airport. So those are service level enhancements. They're new things that we haven't had before. They cost money. We look at council's responsibilities under the MGA. I've summarized some of these sections that you're discharging your responsibility related to financial planning and capital planning today. I'm going to read through these. So a council may adopt an interim operating budget for part of a calendar year. The interim budget that we contemplate, it's in place typically from January 1st to about that first week of April. February 28th is when our assessed values are finalized, so we actually know where growth went in the county. Did it go up, down, stay flat? At that point, we can make a better decision about our tax policy. Moving on, council's responsible to prepare a written plan respecting its anticipated financial operations over a period of at least 3 years. We've got that included in your package here. You'll see that on page 77 of the narrative. You have to prepare at least 5 years capital. We give you 10. We've got 20 in our database, but we only publish 10. You'll find that on page 78 of the narrative. So this meeting really does discharge your responsibilities for financial and capital planning. The last item I want to highlight is MGA 248.1 sub 1. A council may adopt an annual budget in a format that is consistent with its financial statement. So it took us a number of years to get there, but we're quite pleased that we can give you a picture that is the same from start to finish. There's no games that we play in hiding something in a different format that we give you for budget, and then the financial statements that you see at the end of the year look Greek. So I think that's an important thing, that from start to finish you're seeing the numbers as they should be. Roles in the budget process, you may remember this slide from last year. We've got spenders and we've got guardians, and sometimes we wear both hats. There's a little bit of tension there, right? You want to spend and deliver a service, but you also want to keep taxes and debt levels reasonable. Our department heads are our spenders. They do a great job spending money and delivering excellent service, and I think we need to give credit to our department heads for all the work that goes into the overwhelming amount of information that you get in a budget package. I think it continually gets better year after year, more refined, more accurate. And then guardians, that's management, finance, counselors. Let's keep taxes reasonable and make sure that we've properly considered the impact of any proposed budget expenditures. Where are we at in the process? So we already talked about, we've been together previously, had our planning sessions. There's a lot of work that goes into getting a package to a point where I think it's presentable for council. So department heads do their work, they submit it September 30th. Stephanie feverishly gets in there, starts looking through the numbers, making sure that we can balance the budget and how we're going to do that. We asked some of our department heads to defer some capital expenditures. So there's some capital items that are low risk because we have a lot of them. So I'm thinking printers, a lot of IT things. Those are the things that we asked Roberta, what's the risk of running these things into the ground? Can we save $15,000 on a laminator? And that's coming out. We're not going to replace the laminator at all because we've got businesses in town who can laminate things for us, and the volume of laminating that we do does not warrant dropping $15,000. So you'll see that one coming out. So we've done some of that deferring, and trying to keep things tight on budget lines where if we've never spent what department heads have asked for in the past and they're now coming this year and asking for more, we've cut some of those budget lines down. So I'm thinking professional development lines, things like that. We've tempered some of that back down. So today we're going to get into the weeds maybe a little bit. You're going to give us direction. We're going to take notes. If there's any changes, we'll roll those in. If there's really contentious items, we'll put those to an official vote at a regular council meeting so we get clear guidance on where to go. So a few more opportunities coming up November 24th and December 8th for kicking this thing around. So just want to emphasize this is a draft. We can still color and add things and take things out of this budget draft. We won't get too hung up on tax policy today. Administration is recommending a 2.3% municipal property tax increase to help offset the inflationary pressures. We don't have to be married to that number today. We can kick that around. So that's where we're at in the process. Budget pressures and opportunities. It's nice to be right. It's also nice to be accurate and to have confidence in the numbers that we've put in front of you. I can tell you right now, I do not have a lot of confidence in our long-term projections. Todd had a couple, I think it was mowers in the budget, 2 of them for $33,000. He said, it's coming in at 55. Mark's going to tell you about his meeting with buddies at the trade fair. They had a nice John Deere grader there. We just bought 6 graders for $512. That grader Mark was looking at is $770. So we've got a 10-year projection for you where we're always looking forward, but we're really in an uncertain time. We've got uncertain grant funding, high inflation, declining linear assessment, high and rising interest rates, tight labor market, supply chain issues, downloading from the province, police cost sharing. That's another $200,000 plus for us this year. But we have opportunities. Of all the counties in this province, I swear we're in excellent shape to meet the challenges. We have a strong balance sheet. We've got low debt. We're in a position where we can be flexible. Do we borrow? Do we use reserves? We've got tax rates for farmland and non-residential, which are significantly below provincial average. So you've got some room to move and be competitive without crippling your ratepayers. Other opportunities, we've seen some growth in renewable energy. So that's kind of offsetting that decline in oil and gas assessment. Growth in irrigated acres. Not that that translates into a lot of extra tax dollars, but that translates into a lot of extra GDP from this area. That's going to be a positive for us. So we want to see water on the ground. I can't give enough credit to the experienced staff that surround me. Big thanks to them for all the work that went into preparing the budget. I love being surrounded by people who are smarter than me. And I say that in all seriousness. We have these people around. They've been around for a long time, and it shows. We have an excellent staff at the county. Other opportunities, we get to be strategic about how we invest. So I know there's been some asks come in, paving, community halls, rescue rams, communications coordinator. We need to be strategic today about the investments that we're proposing for our ratepayers. All right, let's get into, you can't see that, but that is on page 10 and 11 of your narrative. We have thousands of individual budget items, thousands of GL lines, and it all gets rolled up and summarized into this high-level budget summary for you. Page 10 and 11 of the narrative, yeah. So if we move to the next slide, Stephanie, just high level. Municipal property tax increase of 2.3% or $720,000. Our operating expenses increased by just over 5% or 1.5 million. Your transfers to organizations, so the police costing model chews up a bunch of that. Cost of living adjustments for staff chew up a bunch of that. Within this budget, I'm proposing a 3% cost of living adjustment for going into the new year. When I compare with the 5-year CPI and compare that with the cost of living adjustments for non-union staff over the same time period, the 3%, we're behind about 3.9% as of the most recent CPI numbers. So the 3 makes up some of that, and I'm hoping and optimistic that inflation continues to decrease for the rest of the year, knock on wood. So cost of living, 3% is what you'll see in here. The other item, and I think it's important to highlight, is the amortization expense is up. Right? So as we replace old machinery and equipment with new, more expensive machinery and equipment, your amortization charge is going to go up. And that amortization charge is important because that number drives our savings plan, because we're socking that charge back into our restricted surplus, stabilizes our tax rates, keeps things even over time, and when the time comes to replace a given asset, you've got cash on hand, and you can decide whether we borrow because interest rates are low and it makes sense to borrow and leave your investments working, or if you use your reserves to fund things. The annual surplus projected at 15.2 million sounds like a lot of money. On top of that 15.2 million, we add the amortization charge back, 7 and change. So you've got about 20 some odd million to work with. Where does that money go? We're going to crush gravel, about $2 million. We're going to invest in second phase of the rural water. Silver Sage gets a paving overlay next year. All of those graders that we ordered aren't going to get delivered, so you'll see those have moved into 2023 for delivery. So that surplus gets transformed into tangible things that deliver services for your ratepayers. Capital grants, we do expect to receive some MSI funding for the water project, and we also expect the Canada Community Building Fund, used to be the gas tax fund, of about $450,000 to go towards Terry's shoulder pole program or gravel road rehabilitation. Debt repayment, $666,000. So that's high level for the operating. So this year, this is not a one-year game. So the province has tried to get municipal councils to look longer term. That's why they're asking for a 3-year operating plan and a 5-year capital. We look longer than that. You can't read this thing, but it's your 10-year capital plan. So of everything that we own, water, sewer, paved roads, graders, lawnmowers, this is the scheduled replacement that we've got coming at us for the next 10 years. Looking at $145 million commitment just to kind of maintain what you've got. There is $1.4 million in this schedule for a new fire hall somewhere in the south, but that's really about that and paving Old Highway 1 in 2028 is in here. So that's new stuff, right? There isn't a lot of new stuff in that 140 some odd million. And I would caution you, we need to come back to these numbers to adjust for Todd's mower going from 33 to 55, for the graders going from 512 to 700, and I'm getting sick saying it, right? So you're a target just based on the restricted surplus that you've got socked aside. But that whole program of socking away and saving in restricted surplus is why we're only asking for a 2.3% property tax increase this year, because you've got the capacity to stabilize that with your reserves. So that's your capital plan, big dollars. We look and we match that up with the restricted surplus projection here, next slide. We were at 110.4 million at the end of 2021. Back to the conversation about funding amortization. So we socked that away, and I'm looking to get to the point at the county where we've got our accumulated amortization 100% socked away in reserve. At the end of 2021, we had 80% of our infrastructure accumulated amortization balance funded, 89% for facilities, and 132% for vehicles, machinery, and equipment. Each year, Stephanie's tasked with bringing a restricted surplus review to council. That'll come in the new year, and we're going to have some recommendations for simplifying some of those accounts. But I think when you compare to your peers in the municipal world, we're in a great spot for what we're sitting on, but I don't think it's likely going to be enough, and especially if inflation doesn't reverse course significantly for us. So that's what I get concerned about. When I retire and when this council retires, I want to leave the next crew in better shape than we found it, right? Boy Scouts motto, leave it better than you found it. I'm optimistic that we can get there. So capital, savings, operation, it all takes dollars. So we're looking at taxation. What's the trend been at the county? Well, we took a haircut in 2019. We read the signals coming from the province. Oil and gas needed a break. The county's been about 3 million short since 2019. We've held the line, reduced taxes, and had minimal increases there. Really, I think you want to be on the side of incremental and predictable tax increases. You know, in our budget planning meeting, I said anywhere between 2 and 3%, I think, is reasonable territory for the world we used to live in, where inflation kind of hung around that 2% territory. That might be changing, but and reasonable tax increases to help maintain the level and quality of services. So we've held tight for a number of years. At a certain point, something's going to give. You can only push so much off to future generations before you have to make a change. And we've already talked about our strong financial position. So tax policy will really nail down the details in the new year, but there's a few charts here I wanted to put in front of council just for your information of who's footing the tax bill, who has the ability, and we judge that based on assessed values, and who's paying the bill. So if we look at the 2022 composition for assessment, non-residential about 74%, farmland 4%, residential 20%, small business 2%. And how does that translate over into tax dollars? Well, non-residential is paying about 82%, farmland 3.5%, residential 13%, and small business 2%. So we are vulnerable to what is happening in our non-residential community. So I'm concerned about the assessment model review. I haven't seen what the bookend on that looks like, if there is a bookend. I know Minister McIver was working really hard to try and wrap some of that stuff up, but that's a risk for us. And end of life of some of our oil and gas infrastructure out there. As that dries up, we need to find something to replace it. And that's what is highlighted on this next slide, which shows the trend of assessed values in the county over the last 10 years. So if you look at the individual numbers there, your farmland has increased 10% over those years, or about 13.4 million. Residential, you've seen growth, 15.6%, or 107.5 million. That's not quite enough to offset the declines you've seen in non-residential. Your non-residential has declined 16%, or 570 million from its peak in 2015. So, you know, we talked about a tax incentive bylaw at previous committee of the whole meeting. I think this is a great spot. We got land, we've got water, we're on transportation corridors. we'll be putting some effort into trying to attract some non-residential growth to offset that decline. What's happening with your peers? That's what you see on the next slide here. So from 2018, you know, our last kind of normal year, if you want to call it a normal year, to 2021, what's happened to us as well as our neighbors in terms of change in net municipal taxes? I'm proud to say, you know, we've cut. Cut was justified, and I think it made a difference. We brought in a small business tax rate that saves our small business owners 25% on their tax bill. I think that's something to be proud of. Wheatland County's done some heavy lifting as well, and then you can see the trend for the rest of our neighbors there who have had a little bit of growth. The last few slides, and I'll get off my soapbox so we can get James and Charrett in front of you with their economic update, just show your tax competitiveness. So residential, your average, you're right in line with the average of all MDs, about 98% of the average. You rank 32 out of 63 for your residential. For your farmland, you're at about 68% of the average, so you got 32% below the average rate. And for non-residential, you're at about 64% of the 2022 average. You rank 14th out of 63. Counties who are lower would be Lethbridge, Foothills, Wheatland, Parkland, Willow Creek, Clearwater, Rocky View, Cypress, Bighorn, Greenview, Leduc, Yellowhead, Lacombe. But I think overall, you're in great shape to make some incremental changes on tax rates if necessary. And what I'm hoping, because I'm a foolish optimist, is that we'll actually see some growth in non-residential this year that will minimize what we have to do with those tax rates to keep those competitive. With that, I'll open it up for some quick questions, and then we can move over to James and Charrett.
Thanks, Matt. Are there any questions? Holly, please.
Matt, just a quick question. Can you tell me again where to find the debt repayment schedule in there? I didn't actually see it when I was flipping through. I realized that this morning.
Yeah, you bet. You'll find that in the narrative on page 21.
Any other questions? I'm sure that there will be questions that occur to us and come to us through the course of the day, but those can be raised at the time, any time as well. Any other questions for Matt? Lynette, please, go ahead.
You listed off the MDs that we were different from. Do we actually have that list somewhere?
I can get that list too. Yeah, okay. For all the categories.
If we had it. Okay.
Any other questions? I think it's good to review this. I think I would agree with you that we're in a good position to take leadership for the future, which is encouraging and certainly a good thing for us. And as you indicated, I think our term of tenure here came with, we were in good shape, and I guess it's our goal to, I would agree that it's our goal to leave it better than we found it, and we think we found it in pretty good shape, and that's encouraging, good to note. Any other questions? Kelly, please.
Just a quick comment. I love the back page of this document. That's Fisher Bridge. And if I could just draw it into the budget, this road goes to the oldest financially supportive structure in the county, which is the Bazzano Dam. It supplies water to all of the county of Newell. It's a narrow bridge, so to me that speaks to focus. We're going to focus on money here today. You'll see the water's high. We're in good financial position according to our our CAO today. We have some weeds along the sides of this water, and that's what we're going to look into today. That's just a quick overview of this gravel road that leads to the Bazzano Dam. Fair enough?
Thanks, Kelly. Any others? Seeing none, we'll carry on and move to our economic update from CIBC. Well, welcome to our CIBC representatives. If you would introduce yourselves, and welcome to our meeting today.
Well, good morning, Mayor and Council. Thank you for having us here today. My name is James Hobson, and I'm joined with my colleague here at Charcha Hall. So we manage the long-term investment reserves for the county for the last several years. So we're here today to give you an economic update. The world has changed pretty materially since we last came to present to Council. And as we're going to illustrate here today, even the brightest minds in the world are having a very tough time distilling and trying to figure out what's happening out there. So we'll do our best to kind of summarize kind of the key themes here, what's happening in the world and how it's going to impact Alberta specifically. So we'll chat about central bankers. These are kind of the key players that are moving things around these days and in a pretty dramatic way. Inflation is a hot topic. Everybody's talking about it. We'll chat about interest rates, which is kind of the main tool that central bankers can use to try and bring down inflation. We'll give you a growth outlook and whether or not we're going to face that R word, recession. And we'll wrap up chatting about commodities. So this slide just kind of gives you a sense of how difficult it is right now to kind of understand what's going on. It was kind of a whoopsie moment by the central bankers around the world. Obviously, during COVID, interest rates were slashed to near zero, and we've come out of this COVID situation with some pretty significant changes to the economy and the fundamentals of the financial system. So the chart on the right there, or the picture on the right there, just shows you what the brightest minds in the world have been saying over the past year and a half, and just kind of to illustrate how difficult it's been to forecast this environment. So first quarter of last year, this is Jerome Powell, the head of the Federal Reserve down in the US. He's saying quantitative easing will not cause inflation, period. Fast forward to Q2, he's saying there will be some inflation, but it's transitory. Transitory was kind of the big word that was thrown around all of last year, basically saying that, yes, we have inflation, but it's not going to last. Q3 of last year, inflation starts to run up pretty significantly. Jerome Powell and his team are saying, okay, we have high inflation, but we're peaking. End of last year, they finally came out and admitted, okay, inflation may not be as transitory as we thought, but don't worry about it because the job market and wage growth is still very strong. This is where it shifts pretty materially, and it kind of shocked the whole financial world. Start of this year, the narrative out of the Federal Reserve was, okay, we need to hike interest rates aggressively to curb inflation, but don't worry because the economy is still very strong, and what's called a soft landing is still possible. Now, a soft landing, for those of you who aren't familiar with that, is where you raise interest rates just enough to bring down inflation, but you don't push us into recession. Middle of this year, they came out, they started to realize, okay, we're going to have to hike interest rates so much that it will likely push the U.S. Into recession. But at the middle of this year, they were saying, okay, we're going to have negative growth at the start, but there's still no recession risk. Now, the most recent commentary is, it's kind of a joke at the end, but okay, there's a recession coming, but you will not lose your home. So on the left there, it shows you inflation hurdles to the highest rate since 1981. So we're at a 40-year high for inflation. Many of us have not experienced this level of price increases. And then you can see there Jerome Powell is not happy. We're not envious of his position whatsoever. So what's happened in terms of economic forecasting? I will tell you, I've been doing this for 15 years. This has been by far, I think, the most challenging environment to try and figure out what's going on. And this just shows you the GDP growth forecasts for the major economic zones in the world, the US, the Euro area, and the UK. As you can see, at the start of 2022, the economic consensus was for growth of 2.5% in the US and the Eurozone. If we updated this today, those growth forecasts have basically dropped to zero. So that just kind of shows you the impact of these significantly rising interest rates starting to quell consumer demand. I'll get into this a little bit later, but essentially what we have here is a supply side issue where we've got these massive supply imbalances caused by COVID, bottlenecks. If you've tried to order anything from a dishwasher to a couch, you're waiting a long time. So the problem here is we can't change the supply side of the equation, so they have to go after the demand side. And Canadians are quite sensitive to rises in interest rates, and we are seeing consumer spending dip quite considerably, which is the major factor that goes into growth. So central bankers have turned hawkish. The left there shows you the current benchmark rate. The black line is the Federal Reserve, which is kind of the most important. Kind of interesting thing is the European Central Bank, for the first time in years, has actually come out of negative interest rates. We're actually positive, which is going to have a pretty material impact. The Eurozone is probably the most at risk of recession, almost guaranteed at this point, particularly because of what's going on in Russia and Ukraine and their exposure to the energy bottlenecks there. But just to kind of illustrate, the black line there, it's the fastest, sharpest raise in rates on records dating back to 1962. So pretty material impact on everything that municipalities do. We work with 65 municipalities, and these issues are coming up consistently. We've never had such demand for economic updates. And then on the right there, it just shows you, the expected rate hikes, the expected rates where we're going to end up by the middle of next year. And what's funny is that these forecasts continually get increased higher in terms of where we think they're going to stop raising rates. And why are they doing this? It's to fight inflation that won't go away. You can see there, we saw inflation numbers out of the US as high as 8% year over year, way higher than their central bank target of 2%. The good news is that, I mean, like I said, the smartest minds in the world are having a hard time kind of figuring this out, but the general consensus is that inflation has peaked. Things will come down from here. And, as Matt was saying, those steady kind of gradual rate hikes or tax increases, I think, are appropriate in this environment. The problem here is that the bill's already been incurred. Inflation's already happened. Prices are coming in materially higher for capital projects. But so even though the rate of change will decrease sort of slowly back down by the end of next year to that kind of 2% target, we're still seeing price increases. So even though inflation comes down, prices are still going up, if that makes sense. And just to kind of graphically illustrate what's happening here, this shows you that more than 40 central banks around the world have increased interest rates by at least 0.75%, which is a huge hike, at least once since the start of the year. So it's not just an issue that's impacting North America, but it's in the Eurozone, parts of Africa, Asia, South America. It's a widespread problem, and it's causing, this is kind of off topic, but it's causing what we call a currency war at this time, where, the US dollar has increased so materially because you're paid more to hold US dollars, that if you graph any other currency against the US dollar, it's falling pretty significantly. So when we look at what the Bank of Canada can do, we're kind of stuck between a rock and a hard place. We kind of have to match what the US is doing. Now, this shows you that yields, so this impacts everything from our investment returns to lending rates, have jumped more this year than any year since data started in 1962. So what this impacts, the good news is that our expected return on the portfolio is moving higher. Whereas, a year ago, we were happy with getting, if we could get 2.5–3%, we were patting ourselves on the back. That was about as good as you could get. But those bonds that were yielding sub 2% are now yielding as high as 6%. So that's 3 times the yield. So as these maturities in the portfolio come due, we will be able to reinvest them in the cash flows at much, much higher rates, which is good news. In terms of lending rates, obviously much, much higher. And I'll chat about what our forecast is for those in a little bit here. So this just kind of breaks down. It looks like a complicated chart, but it's really quite simple if you look at it. This shows you the breakdown of inflation. So we are seeing, or we are forecasting, that U.S. core consumer price index pressures to melt, but rent measures will be the last to soften. So the cost of home ownership, which chart we'll get into, is at the worst on record, basically. So in terms of what we see for services, for core goods, we see those coming down quite dramatically, closer to that 2% target that the central banks want to see. We actually see some deflation happening in core goods, which is a welcome sign for central bankers. But one thing we do see kind of persisting is what's called owner's equivalent rent, which is the cost of shelter. Essentially, it just takes more time. Because we're in Canada, we're on 5-year reset mortgages for the most part. It takes time for those interest rate hikes to start to bring down the cost of rent, the cost of mortgages. So that's one to keep an eye out for. The other thing that's not talked about, but it is kind of the silent killer in the room, is wage inflation. So if we look at data in the U.S., which is more accurate than in Canada, we see wage inflation year over year of about 5.2%. So in kind of larger metropolitan areas. So wage inflation is definitely running much, much hotter than what we would like to see. And it's going to be more difficult to attract and retain top talent, especially because municipalities now are having to compete with the private sector to kind of keep their employees happy. So wage hikes very likely on the horizon in that respect. Now, this just is kind of a simple chart. It just graphically illustrates what's called the output gap. It shows you where the economy is running relative to its potential. And what you can see here is that by the middle of this year, the output gap was materially higher than zero, which means inflation is becoming quite pervasive. The good news is that we do see that output gap coming back down to earth. You can see the CIBC forecast is happens a little bit more ahead of what the Bank of Canada is forecasting. But essentially, by the end of next year, we anticipate that output gap to close, which again kind of supports that thesis of inflation kind of coming back down to earth. So I chatted about supply chain issues. So this has kind of been the big issue when it comes to inflation. Now, why is it so pervasive and why are we in this situation? Well, obviously, most of this came out of COVID. So businesses became very efficient using things like just-in-time inventory. So they didn't carry excess inventory to meet this massive run-up in demand that we've seen coming out of COVID. There was a lot of excess savings. There was a lot of cash on the side, mostly due to the significant levels of fiscal stimulus. So consumers were cash rich. And once we came out of COVID, they started spending again. So you ended up with things like, the classic, the toilet paper problem, people hoarding goods, people buying more than they needed. Tight capacity in manufacturing makes it difficult to catch up with all this increase in demand. We've seen resistance to paying market wages, obviously the war in Ukraine, and then COVID-19, which I'll chat about in a second, keeps having an impact on the supply chains around the world. So one big factor that's impacted the supply chain side of things is China's lockdowns, their zero COVID policy, especially recently. So this just shows you that at the peak of COVID in sort of early 2020, China's export volumes were down about 7%. Well, this year, by the sort of middle of the year, China's export volumes were down about 12%. So even more than at the peak of COVID. Obviously, China exports a massive amount of goods, and this is, again, just exacerbating, lighting a fire under that inflation. So where do we see interest rates going? We've seen a lot of hikes so far. Char and I are making fun of our chief economist at GFOA a couple of weeks ago because he kept increasing his forecast for the target overnight rate. We do see them hiking at least once more coming up in the next month. So that should take the overnight rate to about 4.25%. That is obviously 400 basis points higher than where it was just a year and a half ago. Now, we do see what the bond market is pricing in is that the central banks are going to actually they're going to have to start to cut rates as soon as by the end of the year next year, as they've kind of slammed the brakes on this economic growth. So what does that do? So there's a lot of data on the slide. The 10-year government bond is very relevant for us. It kind of dictates our investment returns and our annual investment revenues, but it also impacts your borrowing costs. So the good news here is the bond market is smart. It's forward-looking. We see that the 10-year government bond yields, we believe, have actually peaked. They've reached a peak, and we see them coming down by as much as a full percentage point over the next year and a half. Now, similar story in the U.S. We see them kind of peaking around 4.3%. And then, again, the bond market is pricing in that they're actually going to push us as close to recession as we would be comfortable with before they're going to have to actually start cutting rates.
Perfect.
Okay,
Thanks, James. Yeah. So just kind of piggybacking off what James said there, obviously, rising rate environment, inflation is going to be high. So what does the forecast for growth essentially look like going forward? Well, obviously, the data will line up with what we're saying, and it doesn't take a lot of economics degrees to figure out that the growth is going to slow. So 2022, 2023, even leading into 2024, we see slow growth kind of coming forward with that rising rate environment that we're kind of seeing. The key difference when we compare Canada to what's happening across the world, more specifically geographically Canada and the US, is what's happening in Europe with the geopolitical tension and the war and the tensions that are happening over there, is their central bankers right now are a lot more they're more okay with raising rates to not worrying about a soft landing. If you guys remember what James is saying, we're raising rates where they won't cause a recession just enough. The European economies right now, they're actually going to trigger a recession. They're actually okay with that because of what's happening with the geopolitical crisis. Canada and the US, not as much okay with it as our European counterparts. Me and James have these debates all the time internally. Is there not a way of creating that soft landing essentially in Canada and the US where you're going to raise these rates enough but not cripple the economy? Now, as your previous speaker had said, I too am an internal optimist. However, if we look at the data right now and how it's lining up, you can kind of see that what they're basically predicting for in the economies right now is no recession within the context of Canada. And I'll get into that in a second here. But one thing I will point out, I always like to look at the silver lining in terms of where the forecast data goes. The prairies are going to continue to lead. So it's not like we're going to lead. We did last year. We're going to continue to lead in terms of how we're going to compete against our peers here in Canada. Obviously, that's going to be driven largely by a commodity base that we have in Alberta and Saskatchewan. The large numbers, to give you guys context to what, yes, inflation is high, but commodity inflation particularly, is if you look at 2022's Alberta and Saskatchewan's nominal GDP, 22% and 23% versus real GDP of 4% across the board. Just kind of to speak to you to the impact of that upstream core inflation that they have in terms of where the commodity sector is. Going forward, you're going to see about just shy of 1.5% of growth and just north of 1.5% of growth for Alberta in the next coming years, which doesn't sound like a whole lot, but when you compare it to our peers and even globally, it's not as bad as you actually think it is. We're going to be on par. Now, why are economists right now, and every economist out there is basically saying that the probability, I gotta get the terminology here right, the probability of creating a recession in Canada and the US right now is at 50%. That bugs us. Anytime you hear an economist use the word 50%, that tells you they don't know what they mean, and it's a 50-50 shot. So why they can right now say there's not going to be a recession is the technical definition for recession is 2 periods of negative quarter growth back to back. If you look at the third column in there, 2020, the last quarter of this year, 0%. First quarter next year, 0.2%. That's about as close as you can get to not saying it's a recession without being a recession. So the data right now is essentially lining up to say, yes, whether that may sit at 0% or not, it's going to be a technical recession, whether we like it or not, within the context of Canada and the US. I think that where we've gotten to in terms of rates right now has essentially pushed that to that element in terms of Canada and the US. And from a demand perspective, we just touched on that. Central bankers are basically forced to combat demand because we can't wait for the supply side of the equation to be held up anymore. Consumption obviously going to slow down with that rising rate environment. And if inflation too, the previous speaker, Matt, had mentioned we should see, when will we see and should we see that normalization of inflation? We should see it. It's probably going to happen in the later half of next year. More normalization of the flat forecast of 2% going up further than that. But obviously 2022 and the beginning of next year going to be a little bit of an outlier as it takes time for these rates to kind of take into effect. Now, why that's important, James touched a little bit on housing. It takes time for these for the housing market to kind of lag into here. Data that we're watching in terms of triggering a recession. This is the U.S. housing affordability now at its worst level since 1985. The chart you're just looking at is the average income needed to cover payments of the average home price on a 30-year mortgage in the States. So you can see that it is spiking. So overall costs are going up in the States. What's more important is on our side of the border, obviously. So housing has taken the first hit. We did see a big housing boom led by obviously a drop in interest rates and weird shift that we've kind of seen and kept and going to continue to keep Alberta fairly insulated, where we're seeing this remote work kind of persist a little bit longer, and people are using that as an excuse from BC and Ontario to unlock significant values of their houses, move to the prairies, work remote and working. And you're seeing things like Crow's Nest Pass and all these other municipalities, neighboring guys having these housing booms as well. But that is going to, it did slow down quite a bit into the early part of this year, and it's going to continue with that trend as mortgage rates are continue to go up. Now, the impact, to give you guys an understanding of how much it's going to be and the level of people that's not been exposed and why it's such a lag right now, is because if you look at the percentage of people that are exposed to the current high rate mortgages and high interest rate environment, it's about only 25%. Only about 25% of Canadians right now are exposed to that high level of debt. So that's why we haven't seen the impact yet. That doesn't mean that this year this is going to go from 25% to 100%. It's going to slowly stag in as people have these maturities on their mortgages and they come due. But to kind of give you guys context on the impact that that's going to have, if we look at where mortgage rates would need to be reset from now to 5 years ago on those 5-year reset mortgages, the spread between what a fixed rate is and what a new fixed rate mortgage is, 1.8%. What a fixed rate is to what they're going to be transferring into a new variable rate mortgages is, call it 0.8%, and probably at 1% by the time all of this is said and done. So when you look at that, that is a material shift in consumers' ability to afford mortgages. So it's going to take time for larger and larger percentage of people to get exposed to that. The demographic of the population that's going to be impacted this year are going to feel the biggest increase, as it is going to be steep. Now, James touched on currency a little bit as well. I'll touch on it real quick as you kind of talked a little bit about a currency war, as you global central bankers have been raising rates, and you kind of get stuck in situations like this where, specifically in Canada, where if we don't keep up with the U.S. central bankers in terms of where they're raising rates, you've essentially hurt our exports. So what we've seen right now is a large spike up in currency when the Feds on the south side of the border there spiked their rates at a faster pace than Canada. Essentially, you're getting paid to earn U.S. dollars more than you are with Canadian dollars. So we saw a big run up. There's about $1.37, and then a drawdown back to I'll say $1.33. So still a good spike up in currency right now. That's probably where it's going to persist, as the Bank of Canada likes to keep it in a relative goalpost trading range. So you're not hurting your imports and your exports in terms of currency, but we've kind of seen this across the board as well. Now, pivoting, commodities. Commodities have been a fun one to kind of forecast. The amount of volatility we've seen in these markets has been astronomical. It's been wild, starting from COVID being the perfect catalyst to have a rally in commodity prices, to then the geopolitical crisis in Ukraine pushing it well past sustainable prices. And then you have OPEC come out and actually say we're going to do supply cuts to further put a floor on oil prices. Now, what does that mean for the price of crude oil going forward? Right now, we're sitting at about 86 and change, $86.90 as of today. That's comfortably where we like to see it. There, obviously, as you raise prices, you're going to kill global demand. You kill global demand, commodity prices will slow down a bit as well. But that's why essentially OPEC came out and did its supply cut, is to create a floor price. If I stripped out geopolitical risk and we pulled out the Ukrainian war crisis out of everything, $85 oil is still a very well-supported price. It's a very good price for long-term sustainability. Don't mind seeing that. From a natural gas perspective, $6.70. We've had a big run-up in gas prices. Obviously, that's going to be driven largely in part by seasonality as well. But again, very good complex going forward. From an inflation standpoint, I don't mind sustained high commodity prices. I always like to break up inflation as upstream and downstream. Downstream being your price of your groceries, price of toilet paper, things like that impact our day-to-day. When you have a run-up specifically in Alberta, in upstream inflation in terms of commodity prices, not as bad because it drives employment, it drives higher taxes, and corporations making more revenue. So it has an offset in terms of what we're going to expect. Now, again, I touched on commodities having a recovery, also in the price of autos as well, having the big recovery. If you had the unfortunate situation of having to buy a new purchased vehicle like I did this year, wasn't the best because nobody had inventory, and you basically got stuck trying to provide the price of anything, trying to get in terms of a new car. So, but that from a global perspective, in terms of where we look at where our total exports are and total global demand in terms of commodities and autos, there is room to grow. So what that means is there's a void to fill, and that void is going to be filled going forward, specifically with those exports as well. So very sustainable for us going forward. And why that's that output gap in terms of global demand for commodities is going to be filled by North America is if we look at what's happening in the Russian and Ukraine crisis right now, outside of the human element, the world's response essentially has been to sanction Russia heavily. And when you sanction a geopolitical reason in terms of its exports, there's only certain geographical areas we can get those exports from as well. So if we were to overlay a map of Canada, as you can see here, Canada's exports versus Russia's exports, it's almost a mirror image. So you're going to get a big, good, sustained price, commodity price growth here in Alberta as well. Does that translate into capital projects? Yet to be seen. The big difference between this rally and all the previous rallies, we didn't see capital expenditure programs like we did in the past. So we just saw oil and gas companies just solidify their balance sheets and just hold on because they came through so much volatility, and they just kind of want to wait and do things like dividends and share buybacks. Now, looking forward, kind of summing up where we kind of see the big risk factors in terms of where we see the recession monster looking, is any kind of forecast that's going to impact growth. So excessive rate hikes by central banks, have we already gotten there? That is has yet to remain to be seen. We believe we're pretty much close to that razor's edge at this point. A spike in oil prices over $150, you're going to see forecasts out there with wild numbers. I don't believe that this is reasonable. The world economy has a very good ability to sustain things like this in terms of increasing their supply fairly quickly. So I'm not sure that that's a risk, but a good risk, but it is a risk that's going to be out there. Financial markets are going to have an impact on growth, essentially the wealth effect. People feel less wealthy when the stock market starts to decline. Their pension values will decrease, so they stop spending as much, which just kills growth faster than the central bankers anticipated. Inflation expectations build or supply chain issues deepen. Essentially, you raise rates and you can't crush demand. What happens? Inflation just persists for a long time. So that's where you're going to get a recession for sure. The Ukraine war spreads, you get more geopolitical tension in terms of what's happening with China and Taiwan. And we're hit with a pie in the face. Pie is spelled like that on purpose. We had Delta, we had Omicron. We don't know what the next wave could be. As we said, COVID is the gift that keeps on giving. So we don't know what that looks like, and we don't know how the world central bankers, the global governments are going to respond to it. But that is one that's going to impact how fast the recession essentially comes. So I know this economic forecast hasn't been the rosiest of pictures, and we like to deliver positive economic updates as much as we can. But Canada and the U.S. kind of 23, 24 will have sluggish economic growth, but we're going to be growing, just growing at a slower rate. Recession risks are elevated, with Alberta going to be a growth leader going forward. Europe will most likely see a recession. They're already in there. They're kind of triggering that intentionally, in our opinion. And we need to see slower growth or supply chain improvements to cool inflation, which is where we kind of see that forecast going forward. Now, with that, we have sent you a large amount of data, as per usual, in a short amount of time. So we want to make sure we leave time for questions as well.
Thank you for that. And with that, I'll open the floor of council here for some questions. Holly, go ahead, please.
Good morning. I would say your economic update was definitely on the positive side, given what some of the factors that we're seeing and all the economic updates that have been, not by you, but just by as you're always saying, oh yeah, it's getting better, and to this point, it really hasn't. You know, we have inflation rates in some countries at 300%. You know, if you're looking at Sudan and Venezuela are hovering kind of around there. So if things do go wrong, let's say China invades Taiwan, or we have another COVID, I want to hear some negative suggestions, what we might be facing. This is the positive, which you present. I want to kind of hear the other side a bit more, what we could be looking at.
It's a great question. So in terms of a risk factor, in terms of if we get more geopolitical tension, I'll touch base on commodities. James, you can touch base on like the sustained rising interest rate environment that we'll essentially be in. But what you're going to get is what I had mentioned there, a drive up in geopolitical and commodity prices. When you get commodity prices driven that high, global recessions it's not an if, it's going to be, we are going to be in a recession, and it's going to be a sustained recession. It's not going to be a short one that central bankers can just kind of cut rates. That's going to persist for quite some time if you get that kind of a situation. Now, with that, yes, Alberta is a little bit insulated because we benefit from positive commodity prices, but we don't benefit from rising inflation. We don't benefit from sustained higher interest rates. And James, if you want to add to that as well.
Yeah, I think the short answer to the question is if we see, China invade Taiwan or anything, any major shock, you're going to see essentially a repeat of what happened in 2020. You'd see, the U.S. central bank fire the bazooka, so to speak. They would cut interest rates materially closer to zero. The problem with that is you would end up in an environment of stagflation. You would cut interest rates to the point where, it would, start to kind of rekindle those inflation pressures down the road. You would probably see a fall in the U.S. dollar because, again, they would be cutting interest rates against other currencies just to try and stem demand. But I mean, at the end of the day, those risks are always out there. It's just a matter of how deep that recession would be. And honestly, I don't think it would be appropriate for us to even forecast that at this point. Too many unknowns.
Thank you. One of the risks that you've outlined is the spike in oil price to $150 or more. Can you quantify the risk of that, or the dynamic around that you're seeing? I mean, I understand a lot of it would be outside of Canada, obviously all of it, but maybe just speak to that a little bit if you would.
Yeah, I chose $150 because honestly, Goldman Sachs had an article that said $200 oil. I've seen articles that say it was $300 oil. The reality of a $150 spike is it's a factor because essentially, like what we just mentioned, if geopolitical tensions kind of expand and kind of trickle out into like China and Taiwan, if that happens, you will see an increase in prices. I don't think it's going to be 150. Will it be 3 digits? Yes, $100, $110 oil. To give you guys context, when Russia and Ukraine, that initially happened, we had a massive spike in oil. Absolutely. It's going to be a short-term spike. It's not going to be an increased spike and sustain and kind of sit there. It's going to be short-term volatility because of things like OPEC having the ability to increase supply, because of the things like the U.S. having the ability to increase its supply from their reserves, and Canada responding as well. So is it a risk factor? Yes, in terms of a economic theory. Do I think $150 oil sustainable is on the table? No, because the world markets will increase the supply and just put that demand balance back into shift, back to where they want to see it more fundamentally long term. So not that high of a risk factor in my opinion.
Okay, thank you. Any other questions? Holly, go ahead.
When you're looking at your target rates, you're looking, I think, about a few more, maybe one more interest rate hike or whatever, and then you're looking at kind of thinking rates may start dropping again. Is that you're thinking in terms of to get business going, and or because historically the rates are still low? So why are you predicting a drop?
Yes, I think I'll take that one, Chart. So Canadians are very sensitive to higher interest rates, more so than in the U.S. The reason for it is we have those reset mortgages. In the U.S., people can lock in for 30 years on their mortgage. Those rates are as high as 7%. In Canada, they're either variable or they reset typically every 5 years. So Canadians are very sensitive to higher interest rates. If you mentioned that it's historically not super high, but you've got to put it in context of where we've been for the past decade, right? So when you take the overnight rate from sub 1% to over 4%, it's going to have a pretty material impact on consumer spending. So yes, the bond market's the smart market. It is starting to forecast basically that a soft landing is probably not possible, definitely not in the US at this point. A soft landing would be where you raise rates just enough to bring down inflation, but not push us into recession. So essentially what we're forecasting is, especially in the US, which will trickle through to Canada, is that they're going to raise rates to this point, and it will tip them into a recession deeper in the US than in Canada. But if that happens, they have basically no choice but to start cutting rates. So essentially, that's where the forecast comes from. But great question.
And just to add to that as well, from a historical perspective as well, yes, our rates are still going to be low relative to where they've been in the past, but debt capacity is a lot higher than it was in the past as well. It's very lower than it was in the past as well. Average consumer holds a lot more debt than they have in the past, and that's exactly why people are significantly more sensitive. So why there's a forecast for cuts. And we want to say cuts, not like they're going back to the 0.25% like they did during COVID, but we're talking about 3.5% to 3% into 2024. So it's going to take some time before they come there, but it's going to be a cut, but not back to ultra low interest rates like we just saw.
Thank you. Gentlemen, you're our portfolio managers. What advice do you have for us given the outlook that you've painted for us here? What should we be doing in terms of, you understand that we have options in terms of spending or investing, and can you speak to that on behalf of the long-term growth and sustainability of an organization like ours that has the ability to tax, but also is interested in providing the best strategic direction and leadership for our ratepayers, given what we're seeing, and also the fact that over time we build infrastructure, we invest in infrastructure. What should the strategy for us be, given what you've...
Yeah, so why don't, James, I'll start and you can kind of build on it as well here. But for us, essentially, the strategy, I'll joke, you're just careful to ask a portfolio manager what you should do with your cash because they'll always tell you to deploy it. However, I will say that it all depends on what the current balance sheet looks like for you guys, right? So if you have low debt rates like you guys do, if you have the solidified balance sheet like you guys do, you're in a very envious position. From a portfolio management perspective, to give you guys context, James had a statement in his presentation where he said our expected rate of return is going to go materially higher as we kind of look into the future as well, even with rate cuts. We're talking about north of 5% in terms of where the investment environment is looking right now. And what that means for specifically for municipalities is, okay, yes, we can earn X amount on short-term cash right now, but let's lock in north of 5% for 5 years because we know those rates aren't going to stay there for a long time to offset long-term capital plans as well. And James, if you want to add to that as well.
No, I think you hit the nail on the head. I mean, the portfolio is set up as a simple bond ladder. Everything's principal guaranteed. Everything's MGA compliant. It's a simple strategy, but it's worked well over the long term. What this means is we have cash flows and maturities coming due regularly that we can now take. You know, let's say a bond was yielding 3%. It matures. Now we can take it. And as Char mentioned, the range of returns now is sort of in that 5 to 8% range. We've actually launched some bonds tied to the market that are yielding as high as 8.5%. So you should start to see those investment revenues creep up. It's going to take some time, just given the rate environment we've been in. I mean, if you look at the market, there was literally nothing that you could have done to completely optimize this. I mean, cash was eroded at a rate of 7%. The bond market is, obviously yields are significantly higher now, and the equity market is down. So it's been a very challenging environment. I would say one of the most challenging in my 15 years of doing this. But the good news is, like you mentioned, to support kind of the ratepayers is how do we maximize the revenue that we're getting off of this portfolio so that we can keep up with inflation in real terms to meet those capital projects in the future. But I guess as Char mentioned, and as Matt mentioned, you're very well positioned. Like I said, we work with 65 municipalities. I would say the County of Newell is in sort of definitely the top tier of your capital position right now.
Thank you. Any other questions? Seeing none, thank you for the presentation this morning, and appreciate your input.
Thank you all very much.
Thanks. I'm going to suggest we take a 5-minute break and reconvene at about 25 after 10. Let's call this meeting back to order, please. Just a target note, I'm going to suggest that we break close to 11:45 or 11:45 if lunch is here and our schedule is. If there's a breaking point close to that, we'll try to break a little early for lunch today and then reconvene following that. I expect we'll go past, like we'll be meeting this afternoon anyway, so that's a target. We'll see if we're 5 minutes either side of that or whatever, that's fine too. With that, let's move to item number 7, corporate services. Lane Johnson, welcome, and we look forward to your input and suggest that our discussion today stays pretty high level so that we don't get into details that we don't need to discuss today, but stay pretty high level on the impact of changes in the proposal with regard to our bottom line. Thanks. Welcome, Wayne.
So corporate services includes a few functions. We'll start off with function 23, which is fire, and then go on to disaster and emergency services. Stuart's here to give us an overview on function 23 and 24. You've got the information that's been included in the agenda package, but Stuart can go through some of the detail and provide an opportunity to take any questions that you might have.
Thanks. Welcome.
Thank you. I'll try not to be any more than about an hour and 14 minutes. No, I'm kidding. I hope to be done really quick here. So yeah, if we're looking at our bulletins here, we can see that we definitely have some cost rise in our expense of 23.5%. It's in some ways I'd like to say it's the cost of doing business. My first bulletin up there is the NFPA training that we take, or the training that we do for our firefighters for an ask of $26,000. Currently, there is no budget in the County of Newell Fire Services for doing training at all. We used to have a budget, and it's just recently been reintroduced from the province of Alberta, where they gave out $500,000 every year to the province, and that money was allocated to each municipality depending on the ask and the level of service. What that used to be was roughly somewhere around $15,000 is what the County of Newell would receive. So that had went away, but I truly believe that this recent announcement is in direct correlation with our Alberta Fire Chiefs Association meeting with Minister Chandros in spring at our conference, and our voice was quite loud about how we needed to have that training budget come back. So I'm very happy to see that $500,000 return, and again, that'll only equate to about $15,000. And I have an ask there of quite a bit more than that. And the reason for that is I believe we need to do more than just our minimum 10001 training. We have a whole lot of, our 10001 is our minimum standard for firefighting. So we need more than that, pump operations, wellland, things like that, as I've stated in my report before. So that's where we need that additional money to do 2 courses per year, roughly at a cost of about $15,000 a piece. The second one that's up there is a fire hall master plan. And when I originally approached council about this, it was about doing one area. I see a benefit in doing the complete County of Newell and creating a fire master plan. We currently don't have one. And what this master plan will do for us, for all 10 fire regions, will give our short-term needs. So what do we need to correct here within the first 12 months? Our 1 to 3 year minimum needs, and then of course our long-term. And at the end of the day, what this is going to do for us is create a 10-year budget that will help me and actually help council in that decision-making on why I've asked for certain things and stuff like that as it goes along within the County of Newell. The next one down there, and it is the building repairs. We have $19,000 on there, and that's just for maintenance stuff that needs to be done within the 9 fire halls that are in the County of Newell. So the next one is materials surplus. Bunker gear is a big one there. Our bunker gear for the County of Newell total is close to $500,000. So this equates to roughly a quarter of the bunker gear needing to be replaced in 2023. And that's why we've thrown that in there. The next line down shows the interconnectivity and firewalls for the different fire departments. So we have very, very expensive equipment within the fire departments, and we need to protect that equipment, in particular from freezing. So facilities is actually putting building maintenance programs into the fire halls currently. But in order for Joe to actually see that information come back, it needs to come back into this administrative building. We need to have internet, of course, to do that. The other portion of that is we need to have protection from cyber attacks and things like that. So we need to have firewalls in place. So the ask of that $25,000 is to put that protection in place to make sure that we have it. And then what it'll do in the end is give Joe, in a timely manner, that the heat is down, and he can notify me that the heat is down. And of course, with it being a facility, he would take care of whatever that issue may be. And then, of course, we have the transfer to organizations. So our 3 municipalities, we have contract agreements with them, and we show that we have a $67,000 increase on that. With our capital expenditures, with the Patricia Fire Hall, that project is underway. The footings are in place. We have been wanting to do a site meeting, but of course with the snow falling, there's not much to see there but a bunch of snow on the land right now. So they're working at getting that cleaned out, and hopefully we see it soon. At the end of the day, that project isn't slated to finish till spring of 2023, so we'll have to roll over that money into 2023 to get it done. Our fire engine replacement shows a $600,000 ask, and we've had to increase that from what our 20-year capital budget was. I did some research before we got into budgets this year, and apparatus has increased roughly 25 to 40%, depending on where you're purchasing from and what you're putting into your trucks for equipment. So, you know, if I do a correlation to that, in 2020, Rosemary received an engine for a price of $435,000. So it has increased significantly, but that's since 2020, and the numbers just keep rising. And I'm told with bunker gear, all our big ask prices, we don't see a decrease or a stop in that rise over the next little while here. So, and then finally, under 23 here, we have our vehicle extrication equipment for $30,000. So this year, Rosemary and Rolling Hills are both slated to get the Jaws of Life combination tool into their fire halls. Last month, we had Halamatro and Hearst come in and do demonstrations for us, and they actually showed off that combination tool, and I'll say that Halamatro really outshone, or sorry, Hearst really outshone Halamatro, and that is the purchase that we're doing. But they brought in more than just the Jaws of Life combination tool. They brought in a battery-operated hydraulic ram. Now, what this ram does is, in most vehicle extrications, the person or the patient's legs are trapped underneath the dash or the steering wheel, and that's problematic for us as first responders to get them out. So what we have to do is we actually have to raise that area, and having this hydraulic ram will actually assist with that. The demonstration that they gave to us, and it was really neat to see where they could get that ram to go onto the steering wheel, and they actually drove that steering wheel right out the front windshield of the vehicle. So in turn, by doing that, it really opened up that area that the paramedics and the first responders need to work in. The other part of that was they could take the ram from the foot of the vehicle to the roof and actually extend the open area that we need to work in by almost 2 feet by just pushing the roof of the car up in the air. And I saw huge benefits to that in that timely golden hour that we got to get that patient out of there. It's not just cutting them out. We actually have to remove things or move things to make it work best for the patient and for the paramedics and the first responders to get that patient out of the vehicle. So that's where that increase comes, asking for Rolling Hills and GEM to augment their vehicle extrication stuff and adding that in there. And that's all I have for function 23. If there are any questions with that before we move on to 24.
Thanks, Stuart. Any questions, Holly, please?
Yeah, I was just curious. I know FCC, I think it was, had given somebody to Rolling Hills with something about extrication, if I remember correctly. Am I mistaken about that? And secondly, with the internet connectivity and firewalls, if we've never had that before, I don't think we've had, why now? What's changed?
Well, what's changed is I'm actually working with the IT department as well. The biggest thing that's changed, some of the fire halls do have internet in them. In Rolling Hills, they have it. There are a few fire departments. The 3 municipalities have internet in their fire halls. So there aren't too many of them that actually need to. GEM, Patricia, Scandia, Bow City, those are the ones that currently don't have internet that need to get internet in there. The biggest thing is putting this building maintenance system in there so we can monitor the heat in the building to make sure things don't freeze. And by doing that and having that come back into the County of Newell, it affects how that service is delivered to the County of Newell, thus the firewall and that extra money needed there. Also, I've asked for increases in our level of service with our iPads on our trucks, where we can have fillable PDFs that go right from Laserfiche to the iPad, and once the guys are done filling it out, it goes back to Laserfiche. And by doing that, it's going to streamline Ashley's work. So, of course, with that, again, that's coming into administrative building and back out. And we need to have those firewalls in place to make sure that things like that don't occur, or cyber attacks don't occur.
Thank you. Lynette, please.
I've got a couple questions. With the training, you're saying 26,000, but if I understood correctly, you want to do the training twice. But recommendations is one.
That's right.
That's
Yeah.
okay. And then the vehicle extrication equipment, you just have Rolling Hills and GEM on here. Does that mean everybody else has that already?
A lot of the halls do. That comes from requests basically from the fire halls is what it is. So I do have another request, but of course that has to, it's with the municipality. That request has to go through the municipality before I present to you guys. So, but yeah, those that have vehicle extrication, I can tell you that Brooks, Tilly, and Bizzano, they all have they're all gas powered, not battery operated, but they all do have RAM systems as well. That is part of their extrication as well as airbags. So, but with the jaws and the way they're built now, airbags are almost becoming redundant because it's quicker to use the jaws of life to actually lift a vehicle up than it is to set up the airbag system and get it to go. So, yeah.
Thank you. Ellen, please.
Now, given the economic forecast, the fire master plan, would you and your fire chiefs be able to do that in-house at all? $75,000?
I think it's too difficult, too cumbersome. There's just too much that we need to go through. And at the end of the day, I think what we end up with is an opinion from the fire chief rather than having an independent coming in and telling us where we're good, where we're deficient, and where we need to get better.
Okay, thank you. What are the metrics they use to measure that?
Well, they basically,
I guess what I'm asking is it to a 10 out of 10, or is it what are the comparables that we're trying to achieve?
They'll compare the County of Newell Fire Services, the 10 fire department or fire areas, to similar type municipalities or counties, right? And then that's how they're going to do their comparison on how we come out, right, on certain areas. Do we have enough apparatus? Do we have enough fire halls? Do we have enough personnel? Are we doing enough training? You know, do we have the proper equipment on our trucks? It's quite involved, the whole process to it. And their comparison is basically to a similar type county and type amount of fire halls. For instance, Cypress County would probably be a pretty good comparison to the County of Newell, because they have about the same number of fire halls, probably the same type of population basis to those fire areas as well.
And they're entirely independent?
Sorry?
They're entirely independent?
Yes.
In terms of, that's the business they're in? They're not in collaboration with any suppliers or anything like that? Yeah, okay, that's good. Dan and then Nadina, please.
I had a question on the bunker gear. I know it's good for 10 years, and we're not allowed to use it after expiration date. And I've heard that it gets donated to fire departments in other countries, and I don't know if that's right or not. But is there a way of doing a cost recovery on that where we try to find a market for it before it's expired and have a cost savings there, or is that just ridiculous?
I don't have a good answer for you, that Councillor Short. I know that there is an outfit out of Calgary that has fire gear that is not expired, that they do sell at discounts. I'm not too sure how they purchase that back, and I don't know if there is a cost value to that for us to sell to them. I think they take it and then refurbish and sell if it's still within that 10-year NFPA standard. Definitely something I could look into.
Thank you. Nadina, please.
I just wanted to clarify the extraction equipment for Rolling Hills and GEM. Was that battery operated as opposed to gas? And is that something we have to go with now, or we just choose not to use the gas powered if we don't have to?
It's not something we have to go to. We found that technology and the way it's changed, battery operated equipment works just as well as gas powered equipment. The issue with gas powered equipment to battery operated, you're taking one tool that has the battery attached to it and you can go to where the vehicle is. where with a gas powered, you actually have to take the engine, the hose, the tool, and everything to that one location. And there's a lot of setup to that. So it's definitely quicker and more efficient. And we're finding that, and that's why we do these demonstrations like we did last month, is how many vehicles will it rip open? What is our life expectancy of those batteries? Because I'll be honest, I was skeptical of battery operation being halfway through a cycle and then we can't finish doing what we're doing. And I can say unequivocally with Hearst, both times I've seen their demonstrations now, we're 2 to 2.5 vehicles before we even have to change our batteries. And with that, we have spare batteries that are on our truck. And then there's another backup that we could do where we could actually plug into an extension cord and do electrical. Now, I found that GEM has that option right now, and I'm finding that's an unnecessary cost. It's quite expensive, and they've never used it in the 4 years that they've had their extrication equipment now. So I'm not inclined to purchase that battery or that electric hookup because the batteries typically do the trick for us.
Thank you. Matt, did you have a comment? And then Holly?
Yeah, just a comment. So I did want to remind council of our purchasing policy. So you'll see this fire engine up there at 600,000. It's not going to cost 600,000. It'll probably be more than that. I had somebody sitting in the back row there tell me Clearwater County recent experience, 600 days from order to delivery, 30% increase. They ordered the truck 2020 and it was delivered 2022. They paid $550 for that. They just ordered an exact same unit for $700. So this will be based on our purchasing policy. Council has to approve or award tenders for anything over 350. So you might approve it in budget and it'll be back later next year once tenders come in for you to award tender then. So just remind you of that process.
Thanks, Matt.
And if I could just add to what Matt said there, our Rosemary engine, we ordered back in 2020. We didn't receive it till this summer. Like it was that long of a wait to get that engine.
Okay.
So,
thank you. Holly, please.
Sorry, Stuart, now you've confused me about this extrication equipment, because now you're saying GEM has had it, but it says we need it. And you're talking about someone's got gas. Okay, who's got gas? Who's got battery? And what do we want? And what do we've got?
all right. Currently, Tilly and Bizano has extrication equipment that's gas powered. So that's the engine, the hose, and they have actually a cutter and a spreader, 2 separate tools. And then I think Tilly actually has a combi tool as well, which has both abilities to cut and spread. Currently, right now, GEM is the only fire hall that has a battery-operated combination tool. So that does the cutting and the spreading. It does not have a set of rams. Last year, council approved us purchasing for Rosemary and for Rolling Hills this year extrication equipment, but the RAM was not part of that. After seeing the demonstration of the RAM and the positives of why we want that, that's why I'm asking for that today.
Thank you. Kelly, please.
Morning, Stuart. My question is around the bunker gear. So this would be gear for fire halls other than our agreements, right? Because bunker gear is included in those agreements.
We do bulk purchase of the bunker gear. So with what I'm asking for today, or with the number that is up there today, that is just for the 6. We have actually, there is, that dollar value is higher because in Rosemary, Bizano and Dutchess, they are also receiving a higher number of gear. And I do believe it equates to closer to about $150,000 rather than the 98 that I'm asking for today.
Yeah, I just wanted to be clear that we will see bunker gear in.
It is in those 3 budgets, absolutely.
Thank you. Any other questions? Lynette, please, go ahead.
Just on the fire master plan, through I'm assuming through the province, there's probably some criteria, like maybe even through the COR that we do as safety, that sets out some criteria as to what needs to be in place? Is there something like that, or like this is above and beyond?
Well, I don't think it's necessarily the province that sets that out, or even our safety department. A lot of our stuff comes through NFPA and their standards, and what should be on a vehicle, what shouldn't be on a vehicle. Like if we go into the NFPA for fire engines, they actually have a set how much hose we should have on there, how many nozzles we should have, what is the minimum small tools that we should have on every fire truck, and things like that. Same when it comes to personnel response to calls and things like that. That's a comparison through the different counties and how they are and how we've seen it over the last 20 years or so and what it should be, right? So that's a recommendation made by an independent person that says we're lacking in the number of volunteers that we have, and we need more volunteers to we're not doing enough training, enough first aid training and things like that, because we know that through first responder program and things like that, it's set what we should be training for and what we should be doing and what the minimum standards are. So I don't think the province themselves have a big say in that. It's mostly NFPA, other than through the MFR program. When it comes to the medical end of things, there are certain criteria that each fire hall has to meet in order to be a medical first responder. So that would be through the province, that portion.
Thank you. NFPA, National Fire Protection Association.
Exactly. Thank you. Yes. Sorry.
Kelly, please.
And so just to give some history here, I was around when we decided to buy extrication equipment for the fire departments along the highway. So this will be augmenting that service and taking it throughout the county.
That's right. Yes.
Thank you. Holly, another question?
Yeah, just last question with the fire master plan. If for 75,000, it does seem like a lot when we have departments, but I know you have good records of what we have and what happens, so I'm kind of thinking that seems like an awful lot of money when you already know most of the facts. It's just looking for someone to come in and kind of, give a plan. Is that not high?
I don't have a good answer for that. I do my comparison on, for instance, Taber County just doing one and things like that, and knowing what they paid for a master plan to have an independent person come in and do something like that. I think Matt can speak to that a little better.
Yeah, so I'm hoping the 75 is high because I know what Tabor paid for theirs too. I think the way I kind of look at these studies and contracting out some of the work is comparing it to what it would take to hire somebody internally and set them on the task of doing it, kind of a thing, right? So I know if you task Stu and his very capable fire chiefs to come up with a master plan, you're not going to get it next year. You might not get it the year after, because Stu's going to sit down at his desk and he's going to start typing, start researching, and he's going to get a call to go out. So the benefit of contracting it out is you get it sooner. It's unbiased, and it's somebody who's got a breadth of experience and exposure to the other goings on in other departments that otherwise you're just limited to Stuart and his fire chief's local experience on that. So are they expensive? Yeah, they are. If you pay them to do it, you're probably going to spend $75,000 on their time.
I would also comment with regard to that most of our fire chiefs and firemen are volunteers. So every hour that you consume those people in work for us, it takes out of our ratepayers' business somewhere. And I think notwithstanding the importance of scrutiny on all of this, I think it's strong support for our volunteer crew of people that provide a level of service to us. Thanks. Kelly, please.
I would agree with that. And also I wanted to add regarding this plan is that we have a recreation master plan, we have a capital plan. Why do we not have a fire plan? Basically is my question. It sets out a direction. It tells us where we're at, and it gives us a future futuristic look. So to me, it's money well spent.
Today is an opportunity. Good. Okay. Okay, any other questions? Seeing none, thanks, Stuart.
Perfect. So moving on to function 24 in the disaster emergency services. There's not a ton here. Basically, my position moved over to the County of Newell. So of course it ended that rural fire services contract with the City of Brooks. You know, Lane has asked me, was it worth me coming over here? And unequivocally, absolutely. Yeah, Ashley and I have been a lot more efficient at getting our work done because we're in the same building together. Plus, it's also allowed me to work with, well, the two people on either side of me here. You know, when I've got big projects like the Patricia Fire Hall, the Rolling Hills renovation, things like that going on. So I'm very thankful that the council, in their wisdom, said yes, it made sense for Stuart to move back over to the County of Newell. And as much as I miss being on call, I like being part of this team and moving forward with the County of Newell. So thank you. With that, we have one capital replacement here, and I have a 2017 Dodge half-ton 4x4, and it's had a lot of hard kilometers on it. And with the purchasing policy within the County of Newell, it's due for replacement. So there's an ask there for that truck. One thing that I am doing that we haven't done in the past, typically we did sole source for the fire truck because there's some specialties that go into a fire truck. I am working with our fleet group and working to hopefully purchase the truck through there and getting $1 savings by doing that that kind of work there. So.
Thank you. Matt?
Just also wanted to highlight for council, function 24 is where the donation to Halo is. So we had 50,000 in the budget for 2022. I need to follow up with Paul. I'm sure he's probably got wet ink on a contract with Alberta Health Services, and we've got the full 100,000 in for your 2023 budget.
Okay, thank you. Dan, please.
I had planned a question to ask about the truck and the fleet services, and to hear you say that that's what you're looking into. I appreciate that. I think that's a good job.
Okay, any other questions? Holly, please.
Just really, really quick. What do you need extra in your truck? It's just pure curiosity. Like, what does that mean?
Well, my truck compared to a regular half-ton has the lights on top, the radio inside, an extra battery, iPad, and then right now it's a tonneau cover on the back of the truck, but a topper with a pull-out toolbox because I have my fire investigation equipment back there. I have quick response stuff like a leaf blower for grass fires, swatters, and I got a few little hand tools, Helligans and axes and things like that. So it's a little bit different than just buying a normal truck and going with it.
Well, I was just curious.
No problem. Okay, thank you. Thanks, Stuart. Appreciate that. Lane.
Okay, we can move on to corporate safety. I think it'll be a quick and easy one too.
Good morning, everyone. He thinks this is going to be quick and easy. Yes, it will, I promise. So based on what has been submitted to you this year, just a very brief overview. I think that the biggest change that you will see is the fact that I need some money to contract out for our external audit next year. So that is a number that one wouldn't have seen the past 2 years. Our certificate of recognition program requires that every third year we pay for somebody to come in to audit our health and safety management system to ensure that it meets the partnership standards as outlined by the government of Alberta. So we're guesstimating the cost of that to be about $9,500. Hopefully that is on the high side, but we were told 3 years ago that if our auditor was to return, definitely she already knew in advance that number would be going up because the audit tool itself changed and has expanded, which requires more time on site by her. So that number is $9,500, which you wouldn't have seen last year and wasn't there the year before. Another change is I have lowered the membership and conference fees down to $6,000 from the $8,000. But same message that I would have communicated last year. Generally speaking, my department doesn't do a whole lot of training. I had $8,000 there to spend this year, and I'm just under $1,000. So that would be a cost savings. In addition to that, one of my high dollar values, but it doesn't change, is the whole MSDS online subscription. We pay $7,750 approximately for that each year. And it is a huge, huge benefit that my department appreciates, because prior to having that system do our MSDS sheets for us, we would spend hours and hours and hours trying to look after that piece of our program. I think we had 74 binders that were all different that we had to manage by paper and update as changes happen. So those are kind of my highlights. I probably should have done my homework on this one better, but I'm thinking maybe there was discussion around the fact that Ashley might be going over to help Stuart out on a more regular basis. And of course, Ashley is my part-time fire and safety admin person. In saying that, we have still budgeted for me to continue to have a half-time person, but I have kind of communicated I would like to try going without. So we have the monies there and allocated in case I get myself in over my head by saying that we can do without that halftime, but that is my goal. So if we can do it without, I won't rush into filling Ashley's position if in fact she ends up helping Stuart out more regularly. So with not a whole lot to change, I didn't need a whole lot of additional monies. And given our performance, I think that would further attest to the fact that we don't need additional funding. I just thought I'd do a very brief overview on our annual claims costs. This is a good time kind of to show you that we're working in the right direction and we're doing good things. The first thing I want to celebrate is what our premium rates are for the 2022 year. I am really happy to report that as far back as I can go in time, I have been looking after WCB for 13 years now. I can tell you that our premiums paid this year were basically $35,500. That is by far the lowest premium that the County of Newell has paid by far in the full 13 years. So the only way you can get numbers like that is by positive performance, which means you're not hurting people. And if you are hurting people, they're minor injuries. So I'm really happy to say that over the course of the last 3 years, the last 3 years, we have had 4 individuals see a doctor. The costs of 3 of those 4 were so minimal that we don't even have them associated with our claims costs. WCB has a threshold. If you don't cross the threshold, you don't get charged for them. The one that goes over, sadly, went over by $24. So that's the only reason that one's on the books as well. In speaking to that, lost time claim rates, they are the most important measurement. And a lost time claim is any claim that would prevent a worker from being able to come to work the day after. So that's usually based on the severity of the injury. So I'm highlighting on this, and I'm also knocking on wood. Please do the same. Sometimes I burn myself when I give us big kudos. But because this opportunity may never come again, I would like to communicate as related to lost time claims, our frequency rate of hurting people and it becoming a lost time claim for the years 2020, 2021, and 2022, all three of them, 0, 0, 0.
Here.
Here is right. Severity of the ones that we did hurt, how bad? For 2020, 2021, 2022, 0, 0, 0. When it comes to average claim costs per lost time claim, same thing, 0, 0, 0. This just doesn't happen, honestly. And the evidence is in WCB's report, and that's what I'm reading off of. So with that being said, I'm really close to wrapping up. We are 55 cents per $100 of assessable earnings, lower than industry rate. Essentially, huge dollar savings that go with that. If we were a poor performer, potentially we could be spending $250,000 more per year on our premiums. So we never ever want to put ourselves in that position. Our performance has been so good in comparison to improving our performance and maintaining industry leadership that we are being offered a 40% discount. Having our certificate will actually reduce things by 20%, which will equate to about $18,000 coming back to us in the spring. So when I talk about improving our performance, for the 3-year period of 2019 to 2021, our claim costs, 0. And we're talking dollars. For 2020 to 2022, claim costs, 0. Maintaining industry leadership, for the 3 years prior, we were 95.53% lower than industry. And for the most recent 3 years, we are 100% lower than industry. So with all of those good news, good numbers, that is why I do not need more money and think I can do a little bit more with less. But everybody needs to knock on wood. And that's all I got.
Thank you. Good to hear. Thank you for that. Any questions? Perfect. Thanks. Thank you.
I just want to thank Sherry as well and her team. I think we certainly are getting value for the dollars that are invested with our safety program. And its evidence has been presented for us here today. Thanks.
Thank you. Sorry. Go ahead.
Just where the WCB premiums we pay, where do they show up in the budget? Like where would you find them?
They get rolled in with salaries, wages, benefits. So it's on the benefits line. Yeah.
Okay, the next functions that we can move on to then is function 11, which is the council legislative function. Really nothing much to touch on there. It's pretty much business as usual. I don't know if you want to. Okay, so this is just highlighting the changes from last year to this year. Really, again, there isn't too much that's planned for as far as dollar impacts for 2023. I don't know if there's any question that you want to have or discussion on this particular function.
We did top up the public relations line item a little bit, just on account of pursuing additional meetings with the EID, inviting Cypress County out for lunch, things like that. So a few extra dollars there, but nothing outrageous. Okay.
So the next function is function 12 then. This is the administration function. Again, it's for the most part business as usual. A couple things to note there. We did have our change in the way assessment services were being delivered. We're no longer in a contract arrangement. That is now a staff position. We're also including an amount for a communications coordinator. That is going to be offset by removing the position of manager of finance. So salaries really are coming in fairly close to what they were last year with cost of living adjustment that's showing up in here as well. Other things that are included, just there's some software and hardware upgrades. And then, of course, we have video conferencing equipment that is scheduled for replacement within council chambers here as well. And I think Roberta would be able to speak to a part of that during her presentation.
Sorry, Holly, question, please.
Has it been decided if the communications coordinator is going to be a full-time, like a full-time but a contract or a permanent employee? Has that been decided?
We're projecting it would be a permanent employed position as a contract, as opposed to a contracted position. Is that what you're?
Yeah, I just discussed at one point that they should start out being contracted and see how it went and if it was needed. That was something that was discussed, and I wasn't sure if it went any further than that.
No.
Okay, any other questions? Okay.
Function 51 is Family Community Support Services. Really no change is proposed there. This is an arrangement that we have, of course, with the other municipalities in the region. The City of Brooks administers that, the contract for that arrangement. This is really going to be subject to a budget being submitted by Family Community Support Services. I don't know if there's anything much that can be provided in the way of an update from the member of council that's on there.
Anyone have anything to add there that involved with FCSS? I don't think so. No.
Shannon's in. If you want to come forward, we can have a brief conversation on minibus service.
Hi, so I heard your comments about short and sweet, so it's really short. So I recently took over the minibus, supervising it. So the minibus service provides transportation to and from the city for various riders. Most of them are seniors or people with limited mobility. So they come to town for shopping, doctor's appointments. It's a day out. So we've proposed to raise the rates from $16 to $18 per rider. Or per trip, sorry. And to maintain service levels, a replacement bus has also been included in this year's budget. When I reached out to find out what we're looking at for costs and stuff, they told me the turnaround between ordering and having it delivered would be about 8 months, which is better than some of the other people are reporting. But yeah, so that's kind of why it's in this year's budget. Originally, it was supposed to be in 2024. So we moved it up a year to make sure that we don't go without a bus to maintain service levels. And yeah, that's all I've got for that one.
Thank you. Any questions? Dan, please, go ahead.
I think that's the plan, has been raising the rate $2 a year. I think that's already happened at least once. Have you noticed any decline in usage with the rate increase?
That's, it's hard because like COVID and stuff, and I think we're still coming back from those numbers. And speaking with Anne, some of her previous people, like they make other arrangements, right? So if they were doing that, it's hard to get people to come back to the service. She does do, like last week, she did an evening and took a load of people out to a function at a community center. So I think just keep pounding the pavement and make sure we're out there, that kind of thing. I'll hopefully bring riders back in, but I haven't heard that feedback, so.
Okay, thank you. Any other questions? Kelly, please, yeah.
A quick question. Is the bus the right vehicle? Do we ever analyze and discuss that? Is usership up there enough to warrant owning a $200,000 bus over a van, let's just say? Just so long as we're having the conversation.
Maybe just to speak to that, I know that when we replaced it last time, we reduced the size of it. It's a smaller unit now than what we had. There are times when there's lots of room on the bus, and there's other times when we have a fair number of riders, and between the riders and the stuff that they're purchasing, the space is needed and appreciated. The question could always be explored as to whether or not we should be looking at changing the way the service is being provided. I don't know that we would want to go with a unit that's much smaller than what we have for those occasions when there is a fair number of riders and the space is warranted in those situations.
Good, thanks. I just hope we're having those conversations and taking that into account.
Okay, thank you. Seeing no other questions, thank you. Thanks.
Next one is economic development. Of course, this one covers off the arrangement that we have with the City of Brooks and the other municipalities as well to fund the Joint Economic Development Initiative. It has also included a nominal amount of $3,600 for the contribution to the Brooks Maternity Clinic. That's really what's included under the economic development function. I don't know if there's questions or discussions that you have regarding items here.
Matt, you've got a comment or a question?
Yeah, if there aren't any specific questions about the economic development budget proper, we did include for your consideration a request that came in from our friends north of us, Special Areas Board. I'm not sure if Council had the chance to read about this project they're proposing of putting up I believe it's a 25-foot Mosasaur near the Carolside Reservoir. And the route that goes from Royal Tyrrell Museum past their reservoir and then down through Steveville and you get to Dinosaur Provincial Park is the alternate dinosaur trail, if I remember right. So they sent a request seeing if we'd be interested in partnering on that. It has a ticket price around $65,000 to $75,000. In their original letter, they didn't say exactly what they were looking for, so I put that question to them, well, how much help would you be looking for? And they said, well, anything helps, but $5,000 would be nice. So that's here for you to debate and consider, and if you want to throw a couple of dollars at that, we can roll that into amendments to the budget draft.
Any comments? Do we need to, we don't need to decide that today.
Don't need to decide necessarily, but if I see a whole bunch of shaking heads and hard nose coming out of the conversation, then we won't roll it into the draft budget, but if we see some nods and say, yeah, we understand it's not in our county, but it's on the way, we're not going to fund half of it, but we can maybe support a portion of it, then we'll roll something into your draft budget.
I will say that I did get a call from Jordan Christensen about it, and that seems to be a modest request, really basically for what they're putting in, but that's entirely up to us. I said that it would come to council and we discuss it. Neil, did you have a comment? And then
yeah, it's more a PR thing than economic development, just neighborly.
Yeah. Adina?
I just wanted to say, excuse me, we have discussed this quite a bit at Brooks Regional Tourism. Travel Alberta has designated our area as a Badland zone, and there are signs out there, if you travel that route at all, there are signs out there from Drumheller down 876 to Patricia saying that you're on the dinosaur trail. So it would encourage people more if they had something else to look at besides prairie while they're taking the Badlands Trail.
Ellen, please. Thank you.
Sorry, I must have missed this, but what exactly is the money for?
Can we pull up on the agenda? There is from special areas. They've got an actual mock-up of what a mosasaur looks like. I had never heard of a mosasaur before, being ignorant.
Certainly before my time.
Yeah, it won't be on the planning form. It'll be the letter. There you go.
Yeah.
So a 25-foot one of those is what they're wanting to put up, and I think they do tend to draw tourists, like whether it's the Ukrainian Easter egg or the big fishing lure up in Lacombe, or the Cheeto and Cheetle. It's incredible the magnetic pull or the gravitational pull that these things have. So I think it might be worth throwing a couple of bucks at. I put in our budget planning form. We do have a regional enhancement fund, which has $185,000 just waiting to be spent. And if council wanted to spend some of that, we could take some of the dollars from there to support this. So it would have no impact to your tax rate.
Okay. Any thoughts? I mean, I think as Neil pointed out, it's public relations with the neighbor to the north. They did call about it. They're just, I mean, they're not, they won't disown us if we don't, but I think it's goodwill if we have the budgeting. I have some other ideas with regard to some of these kinds of things, but I won't raise them now. We'll discuss that later on. What do you just nods? I don't see anybody.
Yeah, raise your hand if you're vehemently opposed to
I don't
including $5,000
negative here.
Yeah.
We should just request that it has the county brand on it.
Well, and there's going to be a sign as well with it, so I'm sure we'll get a county logo on that, and I'll send that to Jordan if it's approved.
With the associated Western story of how that brand was put on there.
Yeah, if there's no waiving, don't include it. You're going to see it come December 8th, 5,000 in the budget funded from the Regional Enhancement Fund. And if you've had, a couple of weeks to think about it over time, and if you think it's a bad choice, then you can vote to have it pulled out at that point.
Sounds good. Okay.
So the next one is recreation. For the most part, it's business as usual here. We do have an increase that we're including to cover off the Alberta 55 plus games contribution. And then of course, obligations to our recreation partners is also triggering some changes or increases on the bottom line there as well. This covers off the amounts that's made available to each of the recreation boards throughout the county, as well as the 4 urban recreation funding arrangements that we have with the urban municipalities. Now, also under recreation, I see that there's the request for consideration of funding that has been submitted by the Scandia Community Association for replacing or contributing to an upgrade of that facility. It's not something that the decision needs to be made on today, but the information is included in your agenda package so that you are aware that that is something that is going to be coming up for further discussion.
Holly, you've got comments on that proposal?
Sure. So the history of the Scandia Community Center is included in your package. You can read up on that. I guess I would just say that the hall is, we just call it the hall, is a pretty integral part of our community. Just there's a lot, there's things going on. This past weekend, the community led, but it was attended by many people. We raised, quite a bit of money for a local family. The husband just died and left a wife and 3 children. And it's just without those kinds of facilities, communities just don't happen. If all you have is Greg has spoken often about Lake Newell Resort and having a place to gather, and I think communities need a place to gather. Scandia had hoped to fund more of this, but costs are increasing. We are planning on applying for Community Facility Enhancement Grant, which we can get up to $125,000. Close date on that is January 15th, so we started working on that application as well. And we have been, we did get a second quote now from Armor Building Systems, and we're looking at ways that we can do some cost reductions as well, including putting in the flooring ourselves, looking at not putting in an air conditioning system, just waiting to see how it works out. So the community is looking at options as well to bring the cost down, but we do need assistance. So any questions, just let me know.
Kelly, please.
And just keep track of all that in-kind stuff, because that's all part of the grant process, whether it's here or at CFEP, right? So be sure to include all of that as well, because that works towards, what is it? Our policy is 50% of the construction costs we're asking for.
Yeah, there was a fairly involved process that we went through a couple of years ago that came up with a cost-sharing arrangement. It depends really on whether it's a complete replacement or if it's an upgrade. A number of different factors that come into play there. That's certainly one of the things that we would be asking council to take a look at when the formal funding request does come in. And there is going to be an opportunity for sure to consider that project under that particular program, and there's probably even potentially one other source of recreation funds that could be considered by council as well when it comes time for the actual application to be received. That would be when land is developed, when there's development that occurs, developers are required to put money in place of making land available, and that is another potential source of funds that could be drawn on as well.
Okay, thank you. Oh, Neil, please, go ahead.
Got a couple of questions. Is there any information, like we have over 8 halls at $1 million each, that's $8 million in community halls scattered around the county, and they all serve their purpose. But what do they actually bring in? Like how many days of the year are they actually used?
And that's part of the information that we're asking groups to provide so that they can make a business case for funding that's going to be made available. That information, of course, is maintained, kept by each individual group. It's not something that we have been collecting in the past, but I think it's expected that it would be information that would be provided when an actual application is submitted.
The second part is, are there recreational areas, like if you have a hall, anyone, Rosemary, Rolling Hills, Scandia, what people pay for that? How do you determine those perimeters? Community has to fund 50%, so that comes on a special tax.
There's a couple of different ways that it could be done. A special tax could be applied to all the properties in that service area. That's an unusual way to do that, and it could be considered. It would be a real stretch to do it as a local improvement tax. I don't think it could be done in that, applying that same tool to the properties that are in those recreation service areas. What we're hoping community groups are in a position to do is to rely on fundraising within the area that the facility services. It's not really appropriate for groups to expect that the county is going to be the primary source of funding for upgrading a facility. The initiative that we went through a couple of years ago clearly places a responsibility on the community groups involved to take a lead on fundraising. The county is one of the sources, but it's expected that there's going to be a lot of homework done to come up with funding from other sources as well.
Well, this is where, if there is a problem with the way our divisions are populated, we're putting a heck of a pile of money into some divisions that don't have hardly any people out there. And it may seem to somebody that's not totally fair.
And that's a fair statement. The divisions as they are right now have been loosely established around communities that have historically existed throughout the county. And that's really the way the recreation is being funded as well. It's recognizing the fact that those communities exist, that they do serve a need within the geographic area, that the divisional boundaries are currently based on. The question can be asked, and rightfully should be asked, is there a need, a legitimate need for that facility to continue? One example would be the Millicent Hall. It eventually reached a point where the local community made a decision that it was not worth replacing. The usage wasn't there. The investment that was required to bring it back up to the level that it would have served a legitimate community use, it couldn't be justified. And in that decision, in that situation, the decision was made to just demolish it, do away with the facility altogether, and it has been absorbed into an adjacent area as far as the need that hall was serving. It's possible that some of the other communities that have facilities are going to have to go through the same level of justification when it's time, but that's something that the community needs to be involved with, and council will have to consider each situation that comes in on an individual application basis when that time comes.
Thanks. Okay, thanks. Matt, please.
Yeah, so just for council's information, when the Tilly Curling Club and Minor Hockey Group came in prior to our development of the current recreation facility funding policy, at that time, we had engaged Brownlee to give us an opinion on whether the local improvement tax mechanism could be used for a rec facility. Typically, you'll see them used for roads, sidewalks, the hard infrastructure, water, sewer. So it was coloring outside of the lines a little bit, but the information we got back from, well, if you would have stayed in the tax recovery session at RMA, Greg Plester, he's the one who did the work for us, said, I think you can. You're going to have some risks around defining the benefiting area, to which I'd anchor it to our current recreation area bylaw, which I just emailed to all of council. You can see the different geographic areas. But within those areas, sometimes it's not a clean cutoff, right? So for Bow Slope area, you've got Rainier, Bow City, and Scandia Hall. So you might encounter some pushback from Bow City folks saying, well, we don't want to be on the hook for Scandia's Hall, and Scandia likewise, when Bow City comes in 10 years down, that we don't want to pay for your hall, or maybe we'll all agree to bear the local improvement tax for everybody's halls. But that is a mechanism where, because I think it's really interesting in the county, you have some communities excellent at fundraising. I heard the Bassano fundraiser was a great success, and then there's others, the community is just different, right? So you don't have the same access to fundraising in one area that you do in another. But the local improvement tax mechanism is available. It lets you get the project financed today. And the other thing that's, I think, a feature of that program is it requires the county to prepare a local improvement plan, circulate it to all the landowners who will be impacted, and they have a chance to petition against that local improvement. If the petition isn't, if petitions don't come in, you've got license to move forward with the improvement, and they pay for it over a number of years. You can be flexible with it, but it does make a project that is otherwise out of reach, within reach for certain communities. So we would have a little bit of risk on the defining the benefiting area. And, you know, if we've got some of these rec areas that don't make sense to have 3 in 1, we could maybe do some work to redefine our recreation areas. Food for thought.
Okay, thanks, Neil, and then Kelly.
Would it be worth letting the people who are actually going to pay for it have a say in this, like plebiscite-wise?
Well, that's why I suggest the local improvement plan process. The plan's developed, you know, you say we're going to build a hall, it's going to be this big, it's going to cost this much. Your share is X over however many number of years. If you got issues with that, you can petition it out. The other way is a community could actually petition for a local improvement. So if the Bow Slope area gets a petition for the hall, I think you need 2/3 of the property owners or those with the assessed values of 2/3. Have to brush up on that, but they could petition for it. And that, I think, is a slam dunk for council, because the community's told you, we want this thing, we're willing to pay for it, and here's everybody who supports it. So it makes the decision really easy to tack a local improvement tax onto those who are asking for it, versus the other way of circulating the plan and waiting for opposition to come in against it. You'll end up hearing, well, I didn't get the door hanger, you didn't knock on my door, I didn't hear about it on the radio. There's always somebody who doesn't hear about this local improvement tax that they're now paying for 5 or 10 years, kind of a thing.
I think that those particular have mostly been for more major projects that are infrastructure related, probably other than recreation or community halls. And I think most communities that have a community center that's centered around a hall would probably do a more effective fundraising strategy for their portion, because we're talking about the community's portion of this contribution. I would, even unless a community is petitioning us for that, I don't think we have much interest in really going there, because that really, those need to be community initiatives, as would a successful fundraising strategy to provide the community support for that. So I can't think of a situation where we would want to initiate that at this point, but maybe I'm missing something too. I don't know. But Neil, go ahead.
Well, I think I'm not against community halls or anything like that. But like I said, there's 8 of them around. They all are going to have to be replaced sooner or later. And that is a large number. And to do it so it's fair, I think we have to think about the formula a little bit harder than just throwing 50% in there and the community playing 50. because each population area is different, and it kind of skews the numbers a little bit.
Yeah, it does, in terms of our 50%, yeah. Kelly?
The other, on the top side, the income side of things, these community halls are basically in competition with each other within our municipalities as well. And we never talk about the income side. Are they being fair? Are the users being fairly or equitably charged for the hall in question? We run into that on the recreation side, where we have Tilly competing with Rosemary for ice time, and there's a cut rate over here, so why wouldn't I take my team over here at the lower rate? So there's the income side that we have to pay attention to as well. And we do have some great halls within the county.
Thank you. Dan?
My question is the historic funding of those other 8 halls. How were they funded? How did that all go down? Is there a precedent set for what we should be paying?
The most recent project that we can look back on is the Castles Community Hall. It's the newest of the facilities. I know that the Castles community was certainly involved in raising funds, but they also applied for recreation funding over a number of years from the county. And there were allocations that were made available over, I think it was a 3 or 4 year period before they finally had approval to move ahead with the construction of the project. Beyond that, we would have to do some digging to find out what the history was for some of the other halls that predated the Castles Community Center. It sounds to me like there's going to be some discussion on a agenda for a council meeting in the very near future about the policy that we have in place, and provide a little bit of detail about how that policy was developed and the way that cost shared arrangement was arrived at.
Thank you. Any other questions or comments? Can we move on? Oh, Holly, please.
I was going to go back to those meetings that we had there, Lane, when that policy was developed, and you started out the meetings by saying, not every facility can be maintained. We're going to have to lose some, like, we can't fix everything, right? So it is part of it, figuring out where do we spend your money? And I think that fund has about $6 million in it right now. And the only big draw of it was, I think, the $77,000 that we gave to Rosemary for a pickleball court. So it's the only big draw that we've had. So, how to best use the money is a good point.
Matt?
I don't want to miss an opportunity to put a plug in for the work that's being completed right now on the municipal development plan, is specifically the conversation around rural hamlet and growth hamlets. And perhaps this conversation could inform that conversation and help make it a little clearer to everybody moving forward where the county intends to invest its dollars. I don't think any of those are easy conversations to have when you're looking at right sizing or recalibrating what's available in a community, but they all come with an expensive construction cost, and they don't get any cheaper to run.
Okay, thank you. Kelly?
That last comment just struck a chord with me. Absolutely. The capital is the easy part. We saw that with the swimming pool that we built in Bassano. That's the easy part, building the pool. The difficult part is the operations for the next 30 years. And are we on the hook then to maintain that building once it's there? So thank you for that reminder. Absolutely.
And I guess in the context of that further discussion, we could look at our contribution to recreation in the whole area in terms of increasing costs and what we're trying to achieve with it, because there may be more we can do as well if we choose to. Holly, please.
Well, now that asks me a question. So I know the county has helped supported, ag societies, but has the hall ever helped running of a hall? That's never happened, has it?
Lane?
Yes, some of the recreation boards are making funds available from their annual allocation to offset operating costs.
Absolutely.
Yeah.
Yeah.
Right, but no one's had to come to the county and saying like, we can't keep our hall afloat. Like, we're not seeing that kind of level anywhere, have we?
No,
Okay.
it's coming through the recreation boards.
Yeah. And that's the consideration I would say we have around that, or with increasing costs, is there more we want to do? But, that's a legitimate consideration at some point, probably not to be decided today either. Yeah. Okay, thanks, Lane. Yeah.
So the next function then is library. So that's function 74. Again, it's pretty much business as usual there. Last year, we did include an amount for cultural facilities capital contribution in Brooks. So it's actually dropped down over what was allocated for this function last year. Not much else to provide on the library function.
Any questions or comments about that, Kelly? You look like. Okay.
And the last one is just general government. I don't know, Matt, if you want to take the lead on this part of the discussion.
Sure, and the biggest part of this function is your property tax bill. So I got on my soapbox, and we're recommending the 2.3% increase overall, so $720,000. We also included a discount for those good citizens of the County of Newell, those good residents who come in June 15th and pay their taxes on time. That's an estimated cost of just about $800,000. So, when we're increasing those tax rates slightly, it's also offset by, if you get in here, June 15th, you can get a 2.5% discount. We've also, the other adjustment we made here is a more realistic estimate for our investment income. So you'll see that made a big jump by $700,000 in change. And that's, I think, still conservative. So if you're worried that we're maybe counting chickens before the eggs have hatched, that's based on $110 million in our restricted surplus at 2%. And I heard 5 to 8% today. So we should do better than what's in budget, but I thought we need to make some movement on that just to reflect what reality has been for us the last number of years and looking forward.
Good, thank you. Any questions, comments? Neil?
If my solar comes in like it's going to, there's 5,500 acres out there, and there's several $1 million. You just grab $7 million with interest rates. What do we need your 2.3% for? I don't like doing it just because we can.
Steady Eddie. So you took a $3 million haircut. We're behind where we had planned to be. I put in front of council every year where you're at on restricted surplus compared to what you've burnt in terms of asset useful life. You're not there yet. You're not. Once we get to 100%, I'm happy to have a conversation about let's take it easy. You've taken it easy. You've taken a massive haircut. You've given discounts for people paying taxes on time where we used to penalize them 3%. What I worry about is that fire engine that is in budget for 600 and that we've modeled at 600 and it's going to cost you 700. Or Todd's mowers at 15 that are costing you 22. That whole 10-year projection, it doesn't mean a lot to me. I know it's wrong. We're not high enough on what the costs are. I really hope inflation dips and we get back to normal, but when has inflation ever gone back the opposite way? where we're going to see his $700,000 fire engine come back in at 500, or the graders we bought at 512 come in less than 700. Like that's the part that scares me. Sure, you can do it. You don't need to raise taxes 2.3% next year and you'll be fine, but you're putting it on somebody else. You're putting it on the next council, future generations. I think you've got the capacity to grow your tax revenues by 2.3%, and it's not necessarily going to be done with an increase in your tax rate. It might be some of the solar growth that comes in, but I'd caution you on the solar, that's going up. Your oil and gas is working against that. So, I think we need to do some serious work on attracting non-residential growth here, good non-residential growth that's going to be around for the long term, that stabilizes that burn. Like back to that 10-year assessment, farmland's just steady Eddie, residential steady Eddie, and your non-residential, I don't like the cliff that we're looking at. And we still have the assessment model review to shake out. Like until we've got some certainty from the government on what they're doing with the assessment model and what they're going to do for us on the local government fiscal framework, I'd suggest you got to have a little bit of growth. You've been haircut and flat, and I think you've got an argument for being in that 2 to 3% range, and it's not outrageous.
Okay, thank you. Kelly?
And I agree on that. And I said the same thing at this time last year, that I would go flat last year, but not this year. So I'm in favor of a small increase in keeping our expenses and our questionable areas in line.
Okay, thank you. Any other comments, questions? Lynette, please.
Can we just circle back once again, back to the library? Brooks Library had brought up their funding and wanting to see an increase. Where did we get with users?
Yeah, so
data?
I do have lurking in my emails some statistics, and I have a question that I need to get back to Lisa Patton on unpacking some of those statistics. It's not entirely clear to me who's included in which community groups. So the statistics come out, Brooks, Dutchess, Bassano. It's not clear to me if some of our Div 5 and 10 residents, and so that's home library. So where's the user's home library? I want to see the county folks teased out of that so we can really understand county resident usage, because that would be the one of the metrics to look at in updating that agreement, is that county residents are using City of Brooks Library 5%, 10%. The numbers right now that I'm seeing don't really argue for any change. But I've got more homework to do, so it's in process.
Okay. Back to government, general government. Anything else to discuss there, or are we covered? Okay. We're at 5 to 12. I'm going to suggest we'll pick up information technology after lunch. Roberta, does that work for you? Good. Okay, thank you. Let's break for lunch and reconvene. Yeah, like 1:45 or 1 o'clock. Good for you? Yeah. That's okay. That's okay. He'll be back when he can. We'll reconvene at about 10 to 1. Is that, or is that too long?